Hi, everybody. It's Larry Berman here. Another exciting and volatile week for the equity markets. And in fact, many asset markets had challenging weeks. Let's take a dive into the chart room and see what we learned this week. The updated projection for the Fed dot plots was front and center this week. And the big surprise from the June summary of economic projections was clearly the change in the 2024 projection, where expectations for rate cuts got trimmed significantly and moved up a clear 50 basis points from what they were. And you can see there's general, obviously, short-term consensus around where we're going to be at the end of this year. 12 of the 19 votes think there's one more rate hike coming. 7 think they're going to be paused. And so you can tell from that divergence here, when we look into where they think they're going to be at the end of 2024, with the exception of 2 FOMC members, and 4 that may be unchanged or down 1, that the majority is looking for some degree of rate cuts in 2024. When you look at what their expectations were for unemployment, it actually came down significantly from 4.5 to 4.1. And their call for inflation really didn't change all that much from what it was last quarter. So growth numbers came up a bit. When you throw that all into the mix, higher for longer messaging makes sense. They reiterated that by taking out 50 basis rate points on average that their median forecast would have projected in 3 months ago. When you look into 2025 and now the new 2026 projections, clearly they think by the end of 25 and into 26 that inflation will be back towards their 2% target. But that's a few years out. So the higher for longer message and their ability to cut rates is really levered so much on the economic outlook, and therefore the reiteration of, data dependency. And so their data dependency is clearly looking in the rearview mirror at old data and not so much new data. When we look at the Fed funds effective rate and where we've come from, it's clearly, up. One more 5.6. The median is 5.625. So one more rate hike is likely. When we look at what's priced into the curve, the probability of one by year end or January is halfway priced in to the futures market right now. So not a full rate hike, but that's the data dependency. In the short run, the SOFR curve is well priced. In the long run, we're not so sure. So let's have a look at how various instruments are priced in the market right now. 6 months out is where the peak right now in the bill curve lies. And so if we think about what a 2-year bond is, so the 2-year bond is priced at 5.12. The 2-year bond is effectively 8 quarterly payments of interest rates. So if we're saying that 5.12 is the correct 2-year rate, and the bills market out a year is priced at 5.45, then what they're saying is 2 years out from now that the market would expect approximately for 30 basis points below that, or a bill rate of around 480 on average for the second year, if 545 is the average for the first year and 512 being the average. So again, looking at kind of what's priced into the market at this point, where they are at, by the end of 2025, again, we're looking right now, we'd be looking at the August 25 2-year note. At that point, the linear interpretation of the curve has them Fed funds at 420. And that seems to me too low still. So where you look at what's priced into the marketplace, we're more up here right now. And if you look at where we are a year from now, so the end of 24-ish, and where they think things will be at the median, to me, the 2-year note, again, getting back to this, sorry for bouncing around on you here a lot, folks. The 2-year note probably, if there's one more rate hike coming, probably peaks out around 5.25, 5.30 based on their scenario where what that real value is. So there's a little bit more left in the 2-year on the upside. And then the question is, well, what are these longer term bonds really worth at this point? So the 10-year and the 30-year kind of tested the 450 level. As we sit here on Friday, there's some buying coming into the curve. If you look at where the 20-year note got to, the 20-year bond got to, it's pushed 475 in that kink part of the curve there that's pretty traditional in the long end. So 475 at the 10-year, 30-year, with 5 at the 20-year is probably, pretty really compelling duration valuation. So we are getting close to the end here, and a time where if you're going to bet on a harder landing, you start really getting aggressive in terms of your duration bet on fixed income. So if we look at the 30-year average median for 10-year yields, 30-year yields, that's this red line here. And that number is 467. So we're getting really, really close to it right now. And when you look at where equities were priced on average during the after the dot-com, before the great financial crisis, in that range, equities were priced generally at more of a 15 plus multiple than the current 20 plus multiple, and would argue that in the next 2 years of higher for longer, that the multiple should be closer to this line than it's been trading closer to this line over the last couple of years. And so, back to that line based on forward earnings, that presents a very good possibility that we retest those August lows at some point before we get to good value on equities. So that's kind of in where we're thinking of. When we look at what earnings are, again, on a trailing basis, 220. On a forward 12-month basis, 217. So assuming no earnings growth and a multiple contraction, again, that gets us back to where, the market started the year at 3,800, or, maybe in a worst case scenario, the dip towards last year's lows as the next phase before markets can recover and go higher. I still don't, for the life of me, understand the bull narrative here on the soft landing and why 4,600, 4,800, Ed Yardeni-like numbers, to the end of next year. Something doesn't make a whole lot of sense here. Now, technically, the 41, 4,200 area that was resistance for several moves last year, if we scroll back here a little bit and look, that you could see here in June, here again in August, here again in November, here again in February of this year, here again in April and May of this year before the recent breakout, we're most certainly going to find initial support for the markets in that range, in say between here and whatever the seasonals are between now and say October. And so we would expect some support there. And as data plays out and as earnings come out in October for Q3 and the projections then get updated by companies into 2024 budgets and fiscal and what we think's coming, that's going to define what kind of bounce we could potentially get at that point to what does the next leg down look like, if there is indeed a next leg down, and we think there would be based on valuation and the cost of money staying higher for longer. So this was the soft landing. This was 3.5% 10 years and 375 long bonds. We're not going to get that. We're closer to 4.5 to 475 into next year, and that gets us back down somewhere below 4,000, and TBD on what that is. But if you want to look at it from a technical perspective and throw some kind of Fibonacci type numbers on, and you believe that that's the way to figure out where support is, let me find my Fibonacci here. Throw it on there. And that 61.8% comes down to 39 and change. So there's all kinds of reasons for support at 4,200. But really, I think the reality is we can go a lot lower into the first half of next year, first quarter of next year, after some support at 4,200. So again, message for investors, no pick of the week here. It's really cautionary. We're better off today than we were a few weeks ago with the S&P at 4,500, but there's more work to do, more wood to chop on the downside here before you want to put new money to work or lift hedges or get more aggressive in your exposure to U.S. equities. Have a great week, everyone.